As an investor, volatility, that uncertainty, the ups and downs that the market brings, that's where returns actually comes from. It's a feature of the market, not a bug. I'll explain that, how that works with pictures, that more coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I've heard this equation before: happiness equals reality minus expectation. So what actually happened compared to what you expected? If that's positive, if reality was better than what you expected, then you're happy. If reality was worse than expected, then disappointed. And so here's a question: what do you expect from your investments? What do you expect from your investments? I've gone down that rabbit trail before and talked about how dangerous it is to have really lofty expectations of the market and end up getting disappointed, because the risk is you then make this huge shift and say, I can never experience that again. That was just so awful. And so having the right expectations of the market, super important. Well, just recently, from some folks that I follow on Twitter and different platforms, big shout out to Ryan Dietrich and Charlie Bilio and a few others, but I just saw a couple of charts all within a few days or whatever, and it's like, this tells a story. This tells a story, and it's a reminder, but we need to be reminded sometimes as long-term investors. First, now I've seen this chart 1,000 times, but this shows, almost 100 years of stock market history and just some of the headlines that you experience along the road, right? And these are just the ones that fit, guys. You could have this many headlines just in a typical year. Scary headlines. These are things that, as an investor, will shake the markets, will shake your confidence, will shake your expectations of the future. And yet, despite all of those, now if you zoom in, any one of these, you're going to see the market really reacted strongly. But when you zoom out, they're just little bumps. They're just little bumps. So in the face of all of this bad news and all of those scary headlines and concerns and risks, the market has had an unbelievable run. This goes back to 1900. And yes, there were some awful times, really, really challenging times. And the headlines were very scary and so on. But yet the market, despite all of that volatility, the market has had an unbelievable run. So obviously those scary headlines leads to volatile markets. It leads to markets being volatile. And take a look here, a couple different charts here, but take a look. This one shows the frequency of market declines of different magnitudes, right? So a 3% decline in the stock market from a high point to a low point, it's gonna happen very, very frequently, right? A 5% decline. And so if you've got $1 million saved up, this is a $50,000 loss at any given time. Is gonna happen at 3.4 times a year. It's gonna happen fairly frequently. A 10% correction, on average, guys, this is going back almost 100 years. It's going to happen at least once a year, on average, once a year. And more on that here in just a second. A 15% correction. So again, if you've got $1 million saved up, and because the market's done so well, it's very possible you've got more saved up in your investments than you've ever had in your life. A 15% decline on $1 million is $150,000. That's a lot of money, right? That's going to happen approximately 1 out of every 2 years, okay? And then a 20% decline, called a bear market, that's going to happen 0.3% of the year. So basically, work that math out, about every 3.5 years. Now that's going back to the Great Depression. Just look back over the past 50 years. It's a little less frequent than that. Prior to 1970 or so, they were a little bit more frequent. But yeah, like, this is volatility, or the reaction to negative news or bad news. Volatility, it's a feature of being an investor. It's a feature of the markets. It's not a bug. It's a feature. Now I want to go back to that last chart, but this is my favorite chart that illustrates sort of the same thing, and this is on a year-by-year basis. What sort of intra-year decline will you experience as an investor from a high point to a low point? This isn't at some point during the year you were down X percentage from the beginning of the year, but no, from a high point to a low point. Look at all those red dots there. That on average, the stock market's going to drop from a high point to a low point 14%. Again, on $1 million, that's 140 grand. It's likely you're going to see that size drop in any given year. And yet, during this time period, 34 out of 45 years were still positive in the market, and the market has had an unbelievable run. So short-term volatility, scary headlines are going to happen. It's going to cause short-term volatility, and yet the market still perseveres. The returns that you get as a patient investor is actually the reward for sort of riding through that volatility. Now, go back to that last picture. Have this in mind, right? That since 1928, that a 3% decline in the market is going to happen about 7 times a year, a mild that blah, blah, blah. That hey, this sort of thing happens. Volatility happens. Now let's zoom out. Over that same time period, what's the average growth on $100,000 invested over a certain time period? The average growth over 1 year, that 100,000 is going to grow to 111,000. Over 2 years, growing to 124. Over 3 years to 137. Over 5 years, that 100,000 likely to get a 72% rate of return over cumulative over that 5-year time period, growing to 172. Over 10 years, that $100,000 is going to grow to over $303,000. Guys, that's on average. Going back almost 100 years, that's what your 100,000 turns into. Despite all of those scary headlines, all those ups and downs, take a look at 20 years growing to almost $1 million, 25 years, 1.5, over 30 years, 100,000 on average would grow to $2.5 million. So here's the takeaway. Here's sort of the thread kind of tying all of these charts together and the reminder that I took and that I wanted to share with you. We're gonna face some scary headlines. Even this year, we've already seen some this year, right? Whether you think the trade war stuff is, that's going to be healthy, that's going to be good long term, or if you're like, I don't know how this is going to turn out, right? We're going to see some scary headlines. Even the threat of new technology, right? That has a chance of displacing things and making some big changes and changing valuations, right? For some of the largest institutions. We're going to see some scary stuff, and those scary headlines will create uncertainty, will create volatility in the stock market, and it's that volatility that will end up rewarding patient investors for the returns that we've seen for the past 95 years, 100 years, or even more. That's where those returns come from. Being patient through those scary headlines, those scary events, that uncertainty that we've definitely seen in the past, and we know inevitably we'll see in the future. So, what's your long-term strategy? Do you have the right approach with your investments within your financial plan to maintain that patience through whatever scary events or headlines lie ahead, so that you can work through that volatility and receive the rewards for being a patient long-term investor? I hope so. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.